Hey everyone! Welcome back to Money Mint. I'm Mr. Mint, and today we're talking about something that will determine whether you spend your golden years relaxing on a beach or stressing about money, retirement accounts, specifically Roth IRA versus 401k. Imagine two retirees. One is saved wisely and now enjoys life without financial worry. The other didn't plan and now struggles to make ends meet. Which one do you want to be? The answer starts with understanding your retirement account options. Most people know they should save for retirement, but when it comes to choosing between a Roth IRA and a 401k, they freeze. Which one is better? Which one should you use? The answer isn't simple, but by the end of this video, you'll know exactly what's right for you. Here's a scary fact. More than half of Americans worry they won't have enough money for retirement, and the average retiree has only about $200,000 saved. That might sound like a lot, but it only generates about $8,000 a year in retirement income. The good news, you're watching this video. That means you're already ahead of most people. You're thinking about your future, and with the right strategy, even small amounts saved today can grow into a comfortable retirement. In this complete guide, I'm going to explain exactly how both accounts work, the tax advantages, the rules, and most importantly, which one is right for you at your current stage of life. Let's dive in. Let's start with the 401k. This is an employer-sponsored retirement account. That means you can only get it through your job. Not all companies offer it, but most large and mid-sized companies do. Here's how it works. You decide a percentage of your paycheck to contribute. That money comes out before taxes are taken. So if you earn $50,000 and contribute $5,000, you only pay taxes on $45,000. Your money then grows tax deferred until retirement. That's the big advantage of a traditional 401k. You get a tax break now. Your taxable income is lower, so you pay less in taxes today. It's like the government is helping you save. For 2026, you can contribute up to $23,500 to a 401k. If you're 50 or older, you can add an extra $7,500 as a catch-up contribution. That's a lot of tax-advantaged space. Inside your 401k, you typically get a selection of mutual funds and ETFs to choose from. Index funds, target date funds, bond funds, sometimes company stock. Your employer chooses what options are available. The downside? Your investment choices are limited to what your employer offers. You might not have access to the lowest cost funds or the specific investments you want. You're working with a limited menu. Withdrawals from a 401k are generally allowed starting at age 59 and a half. If you withdraw earlier, you'll pay ordinary income taxes plus a 10% penalty. There are some exceptions, but generally, this is long-term money. One more rule. At age 72, you're required to start taking money out. These are called required minimum distributions, or RMDs. The government wants its tax money eventually. You can't let it grow forever. Here's the trade-off. You get tax breaks now, but you pay taxes later. Every dollar you withdraw in retirement is taxed as ordinary income. So if you're in a high tax bracket in retirement, you might not have saved as much as you thought. So that's the 401k in a nutshell. Pre-tax money going in, tax-deferred growth, taxed when you take it out, limited to what your employer offers, but with high contribution limits. It's a powerful tool, but it's not your only option. Now let's talk about the Roth IRA. IRA stands for Individual Retirement Account. Unlike a 401k, you open this yourself. It's not tied to your employer, and it works very differently from a 401k. Here's how a Roth IRA works. You contribute money you've already paid taxes on. So if you earn $50,000 and contribute $5,000 to a Roth, you still pay taxes on the full $50,000. No tax break today. But then something magical happens. Your money grows completely tax-free. Every dollar of growth, every dividend, every capital gain, no more taxes ever as long as you follow the rules. That's the power of a Roth IRA. For 2026, you can contribute up to $7,000 to a Roth IRA. If you're 50 or older, you can add an extra $1,000 for a total of $8,000. Notice that's much lower than the 401k limit of $23,500. The beauty of a Roth IRA. You can invest in almost anything: stocks, bonds, ETFs, mutual funds, even some alternative investments. You're not limited to a menu chosen by your employer. The entire investment universe is open to you. When you reach age 59 and a half and have had the account for at least 5 years, you can withdraw every single penny completely tax-free. Contributions, growth, everything. Zero taxes. That's the holy grail of retirement savings. Here's another huge advantage. You can withdraw your contributions anytime, for any reason, with no taxes and no penalties. The money you put in is always accessible. The growth needs to stay until retirement. But your original contributions are flexible. But there's a catch. Roth IRAs have income limits. For 2026, if you're single and earn more than $150,000, or married, filing jointly earning more than $230,000, you can't contribute directly to a Roth IRA. High earners need to use a backdoor strategy. And unlike a 401k, Roth IRAs have no required minimum distributions. You can let your money grow forever. If you don't need it, you can leave it to your heirs, who can also withdraw it tax-free. So that's the Roth IRA. After-tax money going in completely tax-free growth and withdrawals. No RMDs, but lower contribution limits and income restrictions. It's an incredibly powerful tool, especially for young people who expect to be in higher tax brackets later. Now that you understand both accounts, let's talk about the fundamental difference. It all comes down to one question. Do you want to pay taxes now or later? Your answer determines which account is better for you. Let's do some math. Suppose you have $10,000 to invest and you're in the 25% tax bracket. With a 401k, all $10,000 goes in and grows to $50,000. You pay 25% tax on that $50,000, leaving you with $37,500 after taxes. With a Roth IRA, you pay $2,500 in taxes now, invest $7,500, it grows to $37,500, and you pay zero taxes. You end up with the same $37,500. If tax rates are the same now and in retirement, the math works out identically. So, which is better? It depends on whether you think your tax rate will be higher now or in retirement. If you expect to be in a higher tax bracket later, Roth wins. If you expect to be in a lower bracket later, traditional 401k wins. For most young people just starting their careers, you're likely in a lower tax bracket now than you will be in retirement. That makes Roth accounts incredibly attractive. Pay low taxes now. Avoid high taxes later. If you're in your peak earning years and expect to be in a lower tax bracket after retirement, a traditional 401k makes more sense. Get the tax break now when you need it most. Here's the honest truth. No one knows what tax rates will be in 30 or 40 years. They could be higher, they could be lower. That's why many experts recommend diversifying your tax treatment. The smartest strategy: have both. Contribute enough to your 401k to get the company match, then max out a Roth IRA, then go back to your 401k. This gives you tax diversification. You'll have options in retirement to manage your tax bracket. Now let's talk about the one feature that makes the 401k absolutely unbeatable. Company match. This is free money, and if you're not taking advantage of it, you're literally leaving money on the table. Here's how it works. Many employers offer to match a portion of your contributions. A common match is 50% of your contributions up to 6% of your salary. So if you earn $50,000 and contribute 6%, $3,000, your company adds $1,500. That's an instant 50% return. That $1,500 free money invested for 30 years at 10% returns grows to over $25,000, all from free money your employer gave you. That's the power of the company match. One catch. Some companies have a vesting schedule. That means you only get to keep the match if you stay with the company for a certain number of years. If you leave early, you might lose some or all of the match. Check your plan documents. This is why the standard advice is, first, contribute enough to your 401k to get the full company match. That's priority number one. Then, if you have more to save, max out a Roth IRA. Then, if you still have more, go back to your 401k. Never, ever leave free money on the table. The company match is the closest thing to a guaranteed return in investing. Always contribute at least enough to get the full match. Now let's talk about the rules for taking money out. Both accounts are designed for retirement, so the government penalizes early withdrawals. Generally, if you take money out before age 59 and a half, you pay a 10% penalty plus taxes. But here's where Roth shines. With a Roth IRA, you can always withdraw your contributions, penalty-free and tax-free. Only the growth is subject to penalties if withdrawn early. With a 401k, everything is penalized. There are exceptions to the penalty. For both accounts, you can avoid the 10% penalty for things like first-time home purchase up to $10,000 from an IRA, qualified education expenses, unreimbursed medical expenses, and disability. The first-time homebuyer exception is popular. You can take up to $10,000 from an IRA, Roth, or traditional without penalty to buy your first home. With a Roth, you can take even more if it's contributions. There's also the rule of 55 for 401ks. If you leave your job in the year you turn 55 or later, you can take withdrawals from that 401k without the 10% penalty. This allows for early retirement. Another strategy is substantially equal periodic payments, or SEP. This allows you to take penalty-free withdrawals at any age if you commit to taking them for at least 5 years or until age 59 and a half, whichever is longer. One powerful strategy is the Roth conversion. You can convert money from a traditional 401k or IRA to a Roth IRA. You'll pay taxes on the amount converted, but then it grows tax-free forever. This is great in years when your income is low. The key takeaway: both accounts are designed for retirement, so avoid early withdrawals if possible. But Roth gives you more flexibility with your contributions. And there are legitimate exceptions if you need the money. Plan to leave it alone until retirement for maximum benefit. Once your money is in these accounts, you need to actually invest it. Just having the account isn't enough. The money needs to be put to work. So what should you buy? For 401ks, the simplest option is often a target date fund. Pick the fund with the year closest to when you'll retire, like 2055 or 2060. The fund automatically becomes more conservative as you get older. It's a set-at-a solution. If you want more control, low-cost index funds are the way to go. In your 401k, look for funds that track the S&P 500 or total stock market. Expense ratios should be under 0.10%, ideally. In your Roth IRA, you can buy VOOVTI or IVV directly. A classic strategy is the 3-fund portfolio: U.S. stocks, international stocks, and bonds. For a young investor, maybe 80 to 100% in stocks. As you get closer to retirement, add more bonds for stability. It's simple and effective. One thing to watch out for in 401ks, high-fee funds. Some plans offer funds with expense ratios above 1% or even 2%. Those fees can eat half your returns over decades. Stick to the low-cost options in your plan. Another warning: don't load up on company stock in your 401k. If your company struggles, you could lose both your job and your retirement savings. It happened to Enron employees. Keep company stock to a small percentage of your portfolio. In your Roth IRA, the investment options are virtually unlimited. You can buy individual stocks, sector ETFs, REITs, bonds, whatever you want. This is where you can be more hands-on if you enjoy investing. My advice? Keep it simple. For most people, a low-cost target date fund or a simple portfolio of index funds is all you need. The key isn't picking the perfect investments, it's staying invested, keeping costs low, and letting time do its magic. Now, let's get practical. Which account is better for you right now at your current age and stage of life? Let's break it down by age group. If you're in your 20s, you're likely in a low tax bracket. Your income will probably be much higher later. For you, Roth accounts are incredibly powerful. Pay low taxes now. Enjoy tax-free growth for 40+ years. First, get your 401k match. Then max out a Roth IRA. In your 30s, your income is growing. You might be in a higher bracket than your 20s, but still lower than your peak earning years. This is a great time to use both. Get the 401k match, max out a Roth IRA. If you have more, increase your 401k contributions. By your 40s, you're likely in your peak earning years. Your tax bracket is high. Now, a traditional 401k becomes more attractive because you get a tax break at your highest rate. Still, get the match. Still consider Roth if you can, but traditional may make more sense. In your 50s, you get catch-up contributions. Extra $7,500 in your 401k, extra $1,000 in your IRA. This is your last chance to save in bulk. Focus on getting as much as you can into tax-advantaged accounts. The mix depends on your expected retirement tax bracket. If you're a high earner above the Roth IRA income limits, don't worry, you can still use a backdoor Roth IRA, contribute to a traditional IRA, then immediately convert it to Roth. It's legal, it's simple, and it gets you access to Roth benefits. If you're self-employed, you have more options. A solo 401k allows you to contribute as both an employee and employer with much higher limits. A SEP IRA is simpler, but quite powerful. Both have Roth options. Talk to a tax professional to find out which one is best for your situation. The bottom line? There's no one-size-fits-all answer. Young and low tax bracket. Roth wins. Peak earnings and high tax bracket. Traditional looks better. But for most people, the best answer is both. Diversify your tax treatment so you have options in retirement. Before we wrap up, let me share 5 common mistakes people make with their retirement accounts. Avoid these, and you'll be way ahead of most investors. Mistake number 1. Not getting the full company match. This is literally leaving free money on the table. Always contribute at least enough to get the full match. It's an instant 50% or 100% return on your money. Mistake number 2. Having the account but not investing the money. Cash loses value to inflation every year. Make sure your contributions are actually invested in something, not just sitting in a money market fund. Mistake number 3. Cashing out your 401k when you change jobs. You'll pay taxes plus a 10% penalty. Instead, roll it over to your new 401k or to a rollover IRA. Keep the tax advantages working for you. Mistake number 4, ignoring fees. A 1% fee might not sound like much, but over 30 years, it can eat 25% or more of your returns. Stick to low-cost index funds and ETFs with expense ratios under 0.10%. Mistake number 5, panic selling during market downturns. The market will crash, it always has, and it always has recovered. If you sell during a crash, you lock in losses and miss the recovery. Stay invested. Stay calm. Time in the market beats timing the market. Let's quickly recap everything we've covered. 401k offer, pre-tax contributions, company match, and tax-deferred growth, but limited investment choices. Roth IRAs offer after-tax contributions, completely tax-free growth and withdrawals, and unlimited investment choices, but with lower contribution limits and income restrictions. Here's your action plan. First, contribute enough to your 401k to get the full company match. Second, if you have more to save, max out a Roth IRA. Third, if you still have more, go back and increase your 401k contributions. This is the standard advice for good reason. If this video helped you understand the difference between Roth IRA and 401k, Please hit that like button. It really helps the channel. Subscribe to Money Mint for more simple money tips. Next time, we're talking about the best budgeting apps for 2026. Especially now that Mint is gone, you won't want to miss it. I'm Mr. Mint, and I'll see you in the next video. Remember, the best time to start saving for retirement was 20 years ago. The second best time is today. Your future self will thank you for the decisions you make now. Take action. Start today. You've got this.